Things are turning sour for Trump and his circle. Really bad, actually. All that loud talk about getting tough on China is beginning to fall apart now that the truth is coming to light. You simply can't punish a country that ends up profiting from your own tariffs. The grand plan to isolate China from U.S. markets looked bold on paper, but reality has crushed that illusion. China's trade engine is roaring. Its net exports reached 6.4% of GDP during the first half of the year, the strongest in more than 10 years. By the third quarter, its export value nearly touched $1 trillion. From the outside, it doesn't even resemble a trade war. It looks like business as usual. Growth, expansion, momentum. That's why Treasury officials, including Besant, are quietly floating the idea of extending the truce, mostly to protect political egos at this point. When you start a global tariff war, it always circles back and hits your own economy harder. And that's exactly what's happening. Sure, the stock market is breaking new records and gold has shot past $4,300 an ounce. But that's not a celebration of strength. It's panic money. Investors are running towards safety because the dollar's value is falling apart. The real health check is jobs, and those numbers are slipping. Job openings have fallen another 2% month over month across the board. White-collar hiring is still 8% lower than before the pandemic, and blue-collar jobs are shrinking too. It's simple economics. When production costs rise, consumers cut back, and businesses stop expanding. To top it off, the U.S. government has been in shutdown for over 2 weeks now, leaving thousands unpaid. Each passing day squeezes small businesses, from diners to big-box retailers like Walmart. That's why Trump is suddenly softening his tone, admitting on live television that the tariffs on China can't hold much longer. It's a clear sign. Washington wants a way out without openly admitting defeat. Meanwhile, China's restrictions on rare earth exports have American industries gasping for air, and tariffs offer no solution to that. What's really worrying policymakers is the possibility that China stays firm. If Beijing refuses to lift its rare earth limits, the cost of U.S. production, already higher than most of the world, will skyrocket even further. Tariffs have only poured salt on the wound. The current effective tariff rate sits around 15.4%, and even switching to cheaper substitutes barely moves it down to 14.3%. There's no escaping the inflation spiral this has triggered, and the biggest hit could come to the very industries Trump promised to bring home, especially semiconductor manufacturing. Right now, the U.S. has about 20 chip foundries, most controlled by Intel, plus a few from foreign firms like TSMC. The AI boom has kept domestic demand strong enough to absorb every chip made locally, but that won't last forever. If rare earth restrictions tighten, producing chips could literally become impossible. Importing them isn't really an option either. It would contradict America's own trade stance, and give Japan and Taiwan every reason to keep their factories where they are. So, in effect, China has jammed the gears on Trump's reshoring strategy. The U.S. blocked Chinese access to advanced chips to slow their AI progress, but Beijing's counter, choking rare earth exports, threatens to paralyze America's high-tech manufacturing, including defense. That's what's truly frightening Washington. In a worst-case scenario, if an armed conflict were ever to break out, the U.S. could find itself without the resources to even produce ammunition. China's defense sector is massive. They can ramp up production roughly 6 times faster than the U.S., maybe even more. With critical metals under export restrictions, American factories could grind to a standstill. It's the same story we saw in Europe, when Russia outproduced the EU in weapons. Only this time, it's on a much bigger scale. So during any new round of negotiations, expect Beijing to play hardball. They have zero incentive to help Trump save face. China could demand a rollback of tariffs, or at least a relaxation of U.S. chip sanctions for the next decade. Washington knows the stakes. America's list of critical minerals, the ones essential for energy and defense, includes lithium, nickel, cobalt, gallium, and several rare earths most people can't even pronounce. Almost all of them are mined or refined under Chinese control. Trump might try buying stakes in global mining firms, but without refining plants on U.S. soil, it's a meaningless gesture. At this stage, big concessions from the American side seem unavoidable. It's hard to imagine China losing this phase of the economic standoff. And just when it couldn't get worse, the U.S. financial sector has started cracking again. Over the past week, a chain reaction similar to the SVB meltdown has begun. It started with Tricolor, a company offering car loans to risky borrowers. They filed for bankruptcy last month, leaving JP Morgan with a $170 million loss. Soon after, First Brands defaulted on $10 billion in debt, reigniting fears about the fragility of private credit. The First Brands collapse is now forcing investors to ask one haunting question: how deep does this instability really go? Rising interest rates have hit the auto parts industry hard. Companies are struggling to meet their debt and interest obligations. It's not a coincidence this is unfolding just months after the trade war began. Tariffs are strangling consumer spending, And those higher borrowing costs are now revealing the hidden weaknesses across Wall Street. Adding to the chaos, U.S. banks are getting hammered by a wave of loan fraud. Zions and Western Alliance both admitted to losses totaling around $350 million. On its own, that's not a huge figure, but the announcement sparked panic. Big bank stocks tumbled, wiping out over $100 billion in market value almost overnight. The real question is how deep this problem goes. Could this be the beginning of another SVB-style financial shock? Nobody truly knows. Under Biden, interest rates climbed close to 6%. Trump managed to bring them down a bit, but remember, the trade war is still alive, and household demand is faltering. Any weak link, from commercial real estate to small business loans, could be the next domino to fall. Ironically, that plays right into Trump's hands. He's pushing for sharp rate cuts, and every new sign of stress in the banking system strengthens his argument. The Federal Reserve is already preparing for a rate cut in October, but Trump's economic team wants to move even faster and deeper. The recent loan fraud revelations give them the perfect excuse. If the Fed waits, the economy might collapse. Their message is simple: cut now or face disaster later. What's worrying, though, is how Trump's advisor Moran is trying to quietly steer the Fed away from its data-driven policy and toward one based on forecasts. That's risky territory, because forecasts are just educated guesses, and Trump knows how to shape those to fit his narrative. But if those massive cuts actually happen, the dollar is going to take a beating. The small recovery we saw last week could reverse in a flash. Sure, that might lift stocks and gold in the short term, but it would be a blow to the broader economy. A classic case of taking one step forward and 10 steps back. That might well describe America's situation heading into 2025. The dollar is once again standing on shaky ground. With U.S.-China trade tensions intensifying, fresh restrictions could hit U.S. exports and manufacturing, putting even more pressure on the currency. But the most immediate threat comes from the Fed's next move. A single cut in October would hurt, but 2 back-to-back cuts could trigger a chain reaction, sending the dollar plunging another 10% for the year. That would shake investor confidence. Holders of U.S. bonds would face weaker returns, especially in short-term securities, and might shift their money into riskier assets instead. Even long-term bonds would lose appeal. Unless the economy fully collapses, that 4% yield won't cover true inflation plus the trade war costs. Despite all that, Washington seems determined to slash rates. A half-point cut by year's end now looks almost certain, and Trump will seize any opportunity to justify it. The whole situation feels surreal, like the economy has entered a twilight zone. Trump's camp is now linking the trade war directly to growth projections, claiming a downturn is inevitable. So, in their view, preemptive rate cuts are the only option. But there's a limit to how far the dollar can fall before it sets off something much bigger. Once that happens, global central banks will accelerate their move away from U.S. treasuries. If America has to rely solely on domestic investors and banks to fund its borrowing, then when the debt bubble finally bursts, and it will, the pain lands squarely at home. And that's before factoring in rising import prices, which will make everyday life even more expensive. The Treasury's position is already weakening. 2 of its biggest foreign holders, Japan and China, have been steadily pulling back. Japan's share of U.S. Treasuries has dropped from 40% in 2004 to just 13% this July. A stunning fall for one of America's closest allies. If the dollar keeps depreciating, others will follow. China's holdings have plunged from nearly 30% in 2011 to just 8% this July, and could slide below 7% by October. Beijing continues to sell, and a weakening dollar only reinforces its decision. That leaves the U.S. trapped between 2 bad choices. Cut rates and you worsen inflation and inequality. Refuse to cut, and you risk another banking meltdown. In the end, Washington will likely take the easier path, printing more money instead of facing a full-scale crash. So get ready for turbulence. The next few months could be wild. Do you think Trump's strategy will backfire against China? And is the dollar headed for another major fall? Share your thoughts in the comments, and make sure to like and subscribe as we brace for what could be an economic storm unlike any other.